Hey traders, I should be on YouTube and the virtual trading floor. I'm doing something a little bit different with this afternoon meeting from this computer to see if it improves the quality. So just let me know if everything's looking good on YouTube and on the VTF stream here. Let's jump into it. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA all of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here are my positions. I got in and out of a bunch of stuff today. Got into and out of Amazon, Google, Snap, Bed Bath & Beyond. Got out of that T-Triple-Q short hedge that I had on. I got back into pins very small. And I started a little position in this 9. With Stefan likes. Let's go over here to the charts. Yeah, crazy day. Let's take a look at the daily chart. Just totally crazy day. If you look at the daily candle, um, it doesn't really look like it was too crazy. Down 1.1%. The Russell's down relatively weak, down just over 1.5%. So again, market was pretty weak. It's day 4. And guess what? The same uptrend pattern happened again today. The question is, will we get a new pivot low or flag type pattern, time and price correction that leads to new highs? Or is this time going to be different where we get a significantly deeper pullback? So, third time this has happened, and just in the last couple of days here, as we were kind of expecting this 3-up day situation, we kept referring to the previous 2 periods here in July in this uptrend where the same thing happened, right? These 3 up days in a row. After 3 up days on this occasion, it led to a 3-day price correction. After 3 up days on this occasion, it led to a 2-day price correction, arguably a 7-day price correction. Really, it was 2 days of time. Time correction. 2 days of time correction, and we broke up. And was followed by 4 more days of kind of time correction there. So that was a little bit of a bear consolidation before we got this next leg up. So the question here is, as we pull back from resistance, as we pull back from extended territory, will the market give us another lower high? And if so, what will that look like? Will it be similar to these other 2 occasions that I just described, where we got price and time corrections that were really pretty shallow? Maybe in this case that'd be like a pullback to 422.50, something like that, into this ADMA, a little bit below the ADMA, maybe even as deep as 420, and then pivoting and going, or just kind of going sideways up here for a while and seeing what happens. Will that happen, or will we get a bit of a deeper correction? And that's kind of what I've been looking for, is more of a deeper price correction at this point into this 420 to 415 area as this 21 EMA is catching up. And then I'm really curious to see if we can get some sort of more major higher low coming to the market at that point. Like I keep saying, I think that the first major pullback in the market, like 3-5% pullback, will be the big test on if this was just another bear market rally or if this is some sort of true bottom in here. So far that hasn't happened. Just one down day today. So, not unexpected at all, right? Yesterday, 430, massive resistance area, 200 day is right there. We clipped that 200 day, pulled back a little bit, had a pretty big gap down this morning. If anything, the surprise is that the market held up as well as it did. I know the Qs and the IWM a little bit weaker, but this SPY held up particularly well. And we were weak in the beginning of the day. As a team, we had a couple good short call-outs off of this opening high, off of the second high. I know there was another little call-out in here that came in that didn't work, but this one is probably the better one off of the shooting star. So we had a couple early short call-outs in this market that led to good downward price action, but it was a Fed minutes day today, so we got choppy. And I remember even saying into the VTF at one point this morning, someone asked me if I thought we were going to get another 11 a.m. kind of melt up in the market, and I said no. I said that I think it's much higher probability that it's a down day today or a sideways day today, especially coming into 2 o'clock. The interesting thing was how the market reacted at 2 o'clock. To me, it seemed like in the Fed minutes that there was nothing really new in there. It certainly sounded a little bit dovish, but it's kind of old data at this point. And my thought process is that even though it sounded a little bit dovish, that the market would have priced that in by this point because we've just witnessed such a big move here recently, and especially since that last Fed meeting. So I would think that that was kind of already priced in a little bit, but initially the market reacted extremely well. SPYs basically fully filled the gap. Qs and IWM a little bit weaker, but were able to break their opening high. Didn't quite fully fill the gap there for the Qs. IWM was weakest, though it also broke its opening high. And then kind of from that SPY gap fill area, we failed all the way back down to where we started. So at the close today, the S&P basically ended where it started at 2 o'clock. So, no major kind of market change came in off the Fed minutes, and I didn't see anything that was, particularly new in there that could get this market super excited. Again, a little bit dovish, but I think it's already priced in. I'm more interested in seeing. I guess we have Jackson Hole next week. Bill let us know. I think it starts on August 25th. I'm going to be more interested to see when we start seeing some more speeches come out from voting Fed members if they look at this market rally and start sounding and acting much more hawkish again, because that's what's been happening a lot this year. Whenever this market starts rallying too much, the Fed starts sounding significantly more hawkish. Whenever this market starts going down too much, the Fed tries to come in and support the market a little bit with their commentary, act a little bit more dovish as they're trying to massage out this potential soft landing for the economy while bringing inflation down. But this move here has just been crazy, and I don't think it's helped their inflation case. But we'll see. It was interesting to see the language, which again I don't think it was unexpected. It was interesting to see the language coming from the Fed that there are Fed members that are worried about hiking too far too fast, that's actually one of the things that I was kind of saying from the start. Like I understand the importance of bringing inflation down. It's extremely important that we do that. Inflation can be a vicious animal, especially if it's prolonged, if it's sustained. But I think when it comes to utilizing a tool like interest rates, it's not like you change the interest rate today and then it has an effect tomorrow. Like it takes time for this stuff to kind of build out into the economy, and when you do very large changes very quickly, I think you open up the potential for something to just kind of crack in the plumbing of the system of the economy that could cause much bigger problems than if you did it slowly. But again, understand the importance of inflation. So they were probably a little late in getting started, but since getting started, it seems like they've done kind of a good job playing catch up. But let's see what happens here. I think that's what the Fed's saying. With that said, this market rally, they're probably looking at it and saying, uh-oh. So that's kind of where we're at. That's where we're at as far as a big picture goes and kind of today's price action. Today's price action, to review the opening game plan, the gap down made the short difficult. Like if you're looking for that short, into this ADMA or deeper into like this 420 area like I'm talking about, it's very hard to short this gap down today. It took away a lot of the shorting opportunity, but it wasn't such a big gap down that you could really be excited about, coming in and buying stock. Like I've got a list of names here that I'm interested in buying, and I was doing a little nibbling on some of them today, though they turned into day trades, like Google, like Amazon, like Netflix. You got back into Snap briefly today. I have an interest in buying. Not that I want to say Snap is a quality company. I don't necessarily think that, but the other ones certainly are. I have an interest in, looking to buy like a market pivot in quality stocks on a dip if it actually were to happen. But, this gap down, coming down a percentage point after this move, I don't think is a big enough of a dip for me to get that excited to buy. And the same thing with the gap down, making it difficult to short, didn't leave us a ton to do. So we said, look for opening signals. I think one of the things I discussed was if you're having like a real downtrend where we're riding that ADMA lower, riding that equilibrium area lower, you will get continuation trades that you can take, like upside shooting stars into the equilibrium zone. And that's exactly what happened. I was a little bit more focused on the Qs, but I do see that there are opportunities there in the SPYs. You can see it in the chart. Well, if you're worried about, and this is my thought process, shorting this gap down versus yesterday's low, the risk reward's no good. If you find something intraday, like shorting off of this high, we called that out. Shorting off of this high that we called out. I think even shorting off this high that was called out by somebody in the team wasn't a bad idea. You know, you pull back into the ADMA, the stock price was coming down here, the market price was coming down, so you're shorting on the way down versus this potential pivot. That one broke. This turned out to be the more real pivot. We called that one out as a potential short. And then there were, you know, some others in here, like maybe this upside tail, you know, pull back to equilibrium short for continuation. The reason I don't like this one as much was because by this point we were getting to the ADMA on the daily chart. So I actually liquidated my TQQQ short that I still had from Rock School out yesterday, which was such a great call out. I liquidated some pre-market, and then I got out of the rest of the position on this candle right here. You'll see when I click back over to the daily chart that this price more or less corresponds with the ADMA on the daily chart for the Qs. And that's all my short was for. The only purpose of my short was to get a move back to equilibrium and just kind of hedge myself for that move. And then when I saw kind of these equal lows come in, at first I was like, maybe I should just trail it to this pivot. I actually put a stop there that I thought was tight just to get stopped out. But then when I saw these equal kind of lows come in, I said, you know what, this met my target. I'm just going to liquidate my short. So that's kind of where I got out of it. And again, this is where there was some other intraday shorting opportunity. If you stuck with those, though, eventually you do get stopped out because midday here the market bottomed out, put a little bit of a bigger bounce, but it's mainly that, you know, sloppier, choppier midday price action. And then, you know, the 2 o'clock rally here is what really would have stopped you out of any intraday shorts. But they all worked, I think, well enough for the most part to kind of get paid on it. So, you know, a little bit of opportunity just on some intraday market action there. Besides that, for me, you know, again, I was relatively conservative. Death and Beyond was a big focus of mine. I basically just did the exact same strategy that I went over in the afternoon meeting yesterday on how I traded it to the short side. Again, today I did the exact same thing, but this time around it made me, I think, more than double what I made on it yesterday. So that was a focus. And then, you know, I nibbled on a little bit of Amazon. I think at like 141 or so, and, you know, kind of caught this bid and liquidated that position into the Fed move. I, you know, nibbled on some Netflix at like 239 and 238, liquidated that position into the up move. I nibbled on some Snap, not a huge position, just a little bit of dip buying, kind of into this $12 area. This was me more buying my stock back a little bit on the original trade that I had that I liquidated above $12 like a day or two ago that, you know, paid me pretty well. Just kind of buying some of that stock back, trading it a little bit, liquidated that into this move, didn't re-enter it into the close. So, you know, all good stuff there. Nothing really to write home about. That CANO was a good one that someone here in the BTF, maybe it was Pat, kind of called out news that there might be some buyout interest in this. So I got in some stock, I think around 485 or so on this first bar. I was originally giving it to this low, raised my stop to this low. I showed this pretty tight, raised my stop to this low when the ADMA caught up and new highs came in, raised my stop to this low when the ADMA caught up and new highs came in, and I just liquidated the position into the close. And then I took a small loss in a little AR trade that I liked, that someone on the team called out today. And kind of this bull flag that was being built. It was looking like energy stocks in general relatively strong. The stock was green. There wasn't much other green names that was out there. So I took this position. The high here was 89 cents. My one-to-one offer was just a couple pennies above that. Wasn't quite able to get the kick, and then I got stopped out in the break of the inside 5. I did not give it to the full low of the flag. I kept it a little bit tight. But that trade just, you know, didn't work out. Lost my risk on it, which is fine, which is more than fine because everything else worked or enabled me to at least cover my risk. So that was it. You know, that was it for me. I didn't do anything with heavy conviction or massive size today because the market wasn't giving me the signals to do anything with heavy conviction or massive size with kind of where we were opening. And awesome, JD. I'm glad to see that. I hope it's good on YouTube too, if anybody's got feedback on what the YouTube looks like. But yeah, so just kind of wrapping up the thought process. You know, we recognize that where we were opening today is probably a less is more type of trading session. So I certainly traded, made some cash flow for myself today, but I didn't, you know, heavily press anything, which I'm fine with and happy about. That's all I got, and I am happy to take a look at anything that you guys have. We scroll up here into the VTF and start at the beginning. What's that Bed Bath & Beyond doing now after hours? Wow, it's still holding in really well. Crazy. I think the first thing I'm seeing here is from Chinggis at 417. Can you speak on what your thought process was on the trade you called out, the low of the hammer pivot at 1420? So you're talking 220 in the afternoon. Oh, right here. Yeah, sure. It's pretty simple. And then you have a second question on Soxel, looks like. So let's start with the first one. So, I wrote into the VTF and I said I don't have high conviction on it. The reason why I didn't have high conviction on it was because my thought process was that what was said in the minutes should be primarily priced into the market. So I didn't have heavy conviction on it, especially the prices that we're currently trading at. But I called it out. It's just a simple trend continuation trade. This is a continuation hammer. That's all. That's all this is. Market has a nice big up move. It gets very extended. It pulls back in the equilibrium area, and then starts to pivot and turns back up. And by the time this candle's closing, you've got a nice little tail here that's about 50% of the candle right into the ADMA. So this is exactly what we look for. It's the opposite of this short. It's the opposite of this short, right? This is these were shooting star continuation candles in equilibrium for trend continuation. This was a hammer candlestick for trend continuation in the other way. We spoke about trend continuation yesterday off of Ahmed's question. We talked about inside five patterns for trend continuation. Well, this is the other trend continuation pattern that I really like. I like the inside five pattern, and I like continuation hammers or continuation shooting stars in equilibrium. And again, it's the candle is the trade, the placement of the candle in the equilibrium zone, the moving averages are the tool, right? So I like these occurring into this 8 to 21 EMA area. So again, just a really strong move here off the minutes. We get up to 429.17 at this candle here with the ADMA being at 427.72. So, we're extended by what, dollar 40 or something like that. We're extended by like $1.40 on the 5-minute chart in the SPYs. Not massive, but it's enough where this market price corrects back down into the equilibrium area, and then just gives you that pivot. So what I always say is that you want to, even if you're buying an uptrend, you want to be buying on the way up. You don't want to be buying your uptrend even on the way down, because there's no promise of a pivot here. We could have V-topped here, especially on Fed Minute News, and gone straight back down to kind of where we started. And that's eventually what happened. But just as a pure technical trade, here's your tail, and you go long off of this low. So you try to buy more or less when the candle closes versus this low. So you'd be taking on, you're buying like 428, stop loss is 427.56. You're taking on 45 cents risk. It's not bad in SPYs. And you could have bought, T triple Q, or you could have bought like SP, what is it, SPXU or whatever it is. The leveraged ETFs that trade a little bit cheaper. I like to trade those a lot instead of actually just trading the more expensive thing here, because I'm getting more stock, more game planability, more percentage movement volatility. And then it gives a nice bounce off of that. Trade eventually fails because the whole move fails, but the move off this was to new highs and certainly more than enough to cover your risk. Hopefully, cover your risk and to book even some further profit, so that when this thing pulls back and stops you out and fails, you make money on it. So again, this is some of the stuff that I'm really trying to hammer home with you guys is learning to be able to trade trend continuation. The trend is your friend. And my favorite ways to trade trend continuation, we've really reviewed kind of in detail between yesterday's afternoon meeting and today's afternoon meeting, for pivots, like for continuation shooting stars, continuation hammers, and the inside candle continuation strategy that we talked about yesterday. So, thank you for the question, Chinggis. Trade 117. I took SPY short at the 10:50 a.m. 5-minute candle. Okay, hopefully early in the candle, like right away. Oh wait, you give me a price here. 425.94. 420. Your price is late. I would like a much better price on that. Took a partial at 423.60. So that's for 34 cents profit. But where's your stop? I think to trade this right, your stop really has to be this pivot high. Maybe you're using the stop of this bar, but this bar is not confirmed by high volume, so it's not important. Either way, even if you were using the high of this bar, which I don't like that out, I like this out much better because it's technically important, where you're taking some off at 425.60 would not be one-to-one on risk unless you're using a different stop loss that I don't understand. So I don't like that area to take profit, and then you're all out at 425.41. I don't like that either. I mean, I guess it's just a pure momentum scalp, which I don't do a ton of that personally. But if it works for you, go for it. Anyway, let me read the rest of your question. This was Majork, it must be Norwegian, of a scalp, but should the stop have been above the 1050 bar or the prior candle? Gotcha. Yeah, so I really think that the stop should be the 10:45 a.m. bar. That's the continuation shooting star candle that I'm describing into the equilibrium zone. That is the true pivot point. The high of this bar, even though it's a negative Maribozu, there's no heavy volume. If there was heavy volume in this candle, I would say you could use the high of the negative Maribozu. Without the heavy volume there, I think it negates the importance of it, and it makes me want to use the actual pivot point. And then again, even though you're taking a scalp, to me that makes the risk reward on where you're booking profit just not make any sense at all. Austin, he looks like Norwegian, right? Majork or Swedish or something like that. But yeah, that's my thought process on it. My biggest concern is the risk reward on where you're booking profit. To me, where you're booking profit, even though you make money on the trade and happy you made money, isn't worth the risk of putting the trade on. You're looking for trend continuation here. So anyway, thank you for the question. I hope that helps. From Austin, 3-part question. How much does luck play into being a trader, and what if someone is a very unlucky person? Should they still be a trader, and when should they finally call it quits? And I love Bill's comment. It's bad luck to be superstitious. So I personally don't like to ever attribute anything in my own trading to luck, even though I do think luck is a factor in trading. I think that luck is a factor. It's like a one-off factor. Like, you show me any individual trade, like in any one trade, I think that there's a luck factor. Not getting stopped out by a penny is lucky. Getting stopped out by a penny is unlucky, and then having the trade work with a shakeout. Getting involved in a trade that's working great, looks great, and all of a sudden news comes out in the other direction is bad luck. Getting involved in trade and all of a sudden news coming out in your direction is luck. So again, in any one individual trade, I do think that luck can play a part in it, but I do not believe that luck plays a part in a series of trades. So, if you're talking about like a month's worth of data or a year's worth of trading data, then I think it's 0% luck. It's no luck at all. It's entirely skill, because stuff will even itself out over time. Yeah, and I really agree with what Mark is saying here. You can't attribute anything to luck, and thinking about it that way does give you kind of negative psychology. It really is you. You're making all of your own choices and all of your own decisions in regards to the market. And look, we all have the one-off lucky or unlucky circumstance that happens to all of us. Like I just described, a couple situations where in any one trade, maybe you get lucky or maybe you don't get lucky. And I like to joke around and say everybody gets lucky sometimes, right? Like I think I even said that to Sharir at one point today. But when you start putting together like a series of trades that define an edge, that's not going to be luck. If you show me 100 trades and show me the risk reward of it or whatever at the end of it, there's zero luck at the end of that. So yeah, so that's my kind of thought process on it. Luck equals preparation plus opportunity. Yeah, I know Redler loves to say that line. That's what it is. So yeah, I make my own luck. You guys see me usually logging into the VTF 6:30 in the morning, starting my research process. I'm one of the first people in here still every day to get my research process going. That is, that's where my luck comes from, is by really working hard pre-market and putting together that morning meeting and knowing what my exact process is going to be for the day. I love the quote that I love. Let me see if I can find it so I don't butcher it. I'm not going to be able to find it quick enough, and I don't want to. Hold on. I can find it. Here it is. I found it. It's a Muhammad Ali quote. The fight is won or lost far away from the witnesses, behind the lines, in the gym, and out there on the road, long before I dance under those lights. That's one of my favorite quotes. That comes from Muhammad Ali, but really applies to trading. I think that my success in trading is from the work that I'm primarily doing outside of market hours. At this point in my career, primarily the pre-market work that I'm doing. But early in my career, when I was working on building my edge, a lot of it was coming from the work that I was doing after the market closed every day. The journaling, the Excel spreadsheets, the focusing on game planning, playing with the numbers. So yeah, I hope that helps, Austin. Just keep putting it together. I'm not sure where you are in your trading career. This business is a tremendously large learning curve. If you're in your first year, if you're in your first 3 months, you have no idea whether or not you can actually be successful in this business or not. I can say that for sure. You have no idea. If you're in month number 3 and you're like, oh my God, I lost money trading, you have no idea whether or not you can be successful in this business or not. Even 6 months in. And the learning curve alone, just get through like the basic portion of this learning curve takes a solid year of work. Again, I don't know where you are in your learning curve, but that's some stuff to think about. And even for myself, I'm 12 years into this. I am still getting better as a trader, and I'm still learning new things all the time. Ramon, can you discuss the concept of a feeler and how does it help you enter trades? Sure. So for me, a feeler is more about an idea than anything else. I'm trying to think about how I want to talk about it. So it comes down to risk, and part of it comes down to what you can afford. Because I remember when I was like a newer trader, and I used to hear guys like Mark Sperling and guys that I really looked up to as traders who were super experienced talk about putting feeler positions on, and maybe if they just buy 100 shares of a stock, and they don't care if it bleeds against them. When I was a new trader, that sounded crazy to me. Because when I was a new trader and I was just getting started in the business, there was no way I could buy 100 shares of a stock and just let it go like points against me and not even like think about it and not worry about it. But now with where I am in my career, I actually do that. I do that a decent amount. So buying a feeler for me is more about like bookmarking the position. Like if I wanna keep an eye on this, I want to bookmark it. Like I'm really interested in this stock for whatever maybe fundamental thesis I've come up with. So I'm just gonna buy like a really small position, and that way I start watching it, and I start watching the technicals, and I see how this thing trades, and I see how it begins to play out, and I can look for an opportunity to get heavier